as Israel and Iran continue to trade attacks. U.S. President Donald Trump left the Group of Seven meeting yesterday in Alberta to deal with the crisis. Let's get the views on all this and the markets from our featured guest of the morning. He's John Zechner, chair and founder of Zechner Associates. John, thanks a lot for joining us. How much do you think, John, about geopolitical events like this as you manage client money?
Well, they're important. I think what's going on in the oil markets is probably less of an impact than what we're seeing on, the trade and the other side of things. Because quite honestly, when you think of it, for the amount of conflict we're seeing with bombs flying between Iran and Israel, look at the oil prices. I mean, you can't even really push $70 a barrel or barely through it. So, and I think the issue there, obviously, is there's still a lot of excess supply, from the OPEC plus producers that's sitting ready to go. Unless you get into some problems, Paul, in the Strait of Hormuz, or they block exports going out, I think the realization is the oil market is pretty well supplied at this point. So even if there are some, short-term risks, in the end, we're not going to see a big move. So, we were sort of fading the rally a little bit on some of these oil stocks because I still don't think, I think oil is probably headed back towards $60 a barrel or maybe lower due to, global economic risks and other things and oversupply in the short term.
You are cautious on this rally, and you'll tell us more about that through the course of this half hour. But tell us why you're beginning to doubt the quality of the stock market rally.
Well, and I got to step aside always with Paul. Paul, as you know, the view for a lot of investors, which is right, just you be a long-term investor and don't trade the market. But people like myself, we make our living sort of trading the market. So, I do look for shorter-term moves that we can go in and out. And what worries me right now is the rally that we've seen off those April 7th, April 8th low is becoming narrower. It's not typical of what you should see of a broader expanse. I mean, you sort of look at it, defensives are outperforming cyclicals. Large caps are outperforming small caps. The financials are not really playing, a great role in this advance. And we've been concentrated back on some of the big tech names as well. And it was an oversold market. I mean, sentiment got extremely low. People got worried. And the algorithmic trading sort of took a lot of money. Hedge funds, they were sort of at a low point. They were short, and you had a bit of a buying frenzy to get back in. And I think beyond that, it's hard to see a lot supporting this because nothing has changed. I mean, we've still got the same trade terror of risk facing us for the next number of months, the economic risk, what's happened with the budget bill, the fact that interest rates are higher than they've been in the past, even though they may come down a little more. Valuations are right at the high end of the old ranges. You're back to close to 22 times in the U.S., despite people being, somewhat bullish on the earnings outlook. I'm less bullish in that regard. So you add all of that, and then the sentiment. The Bank of America survey, I haven't had a good look at. Apparently, is out again this morning. I'd be interested to see what that says. But Goldman had a stat yesterday that was astounding. 49% of U.S. assets now are into stocks. Unheard of record. So, I mean, everybody is in. The public is really in on this one. The algos are in on this one. The expectations are very high, and it's getting narrower and narrower advance. I mean, the breadth is decreasing. And all of that, I thought, whatever your long-term strategy is, whatever your asset allocation is on a longer-term basis, in terms of your equity exposure, I would be sitting at the lower end of that equity exposure right now and be in somewhat of a defensive position within those holdings.
Whatever happened to the rally in small cap stocks, John, when this year began, that the Russell 2000 was outperforming the S&P 500, and the call from a lot of professional investors was that was a trend that was going to continue.
Yeah, and you need probably better economic conditions and a better expectation of economic conditions for the Russell to continue to outperform. Because think of it, I mean, one of the stats I saw last year that was 42% of the Russell 2000 companies were still losing money. There's a predominance of smaller financial service companies within that, and a lot of domestic U.S. businesses. And you look at it, a lot of those are sort of the front end of companies that can be hurt by the tariffs going forward. So, I think that's the problem is I don't think you're getting the type of economy realistically in the views of and spending and other factors you need to sustain this in order to get this, exceptional growth going forward. And look at it, I mean, we just saw the OECD and the IMF, they've all downgraded their global growth expectations to numbers we haven't seen in years. for this year and next, mostly because of the tariff risk, but also because of the slowdown in China, the war, other things. So you put all that together, and yeah, in that environment, you're going to have a hard time seeing the small caps, which are very domestically, economically oriented, outperform. And what you see just is a gravitation back to the one sector that continues to win and continues to deliver earnings growth, which is technology. And I mean, by default, it's hard to argue with that.